Good morning, traders. Welcome to Trading Together. I'm Mel Gacee. Today is Friday. Yes, it's Friday, and it is February the 13th. Welcome, everybody. Good to have you here. Um, Good to see you, Freaky Turkey. Good morning. And Anna is here. Good morning. Happy Friday, everybody. I hope you have a wonderful weekend planned. And Valentine's Day is not just for your special person, it's also just for the people you love. So I hope you all get a chance to tell somebody that you love them this weekend. All right, guys, we are going to take a look at these charts. We opened up today right after CPI, or as I like to call it, CPI, the Consumer Price Index. This is one of the gauges that the feds use to monitor inflation in the United States. So it is an index that kind of gauges what consumers are spending. I call it CPI because, as you and I know, in the real world, we are spending a lot more than we did last year at this time, 2 years ago at this time. Groceries are up an ungodly amount. It is just becoming more and more difficult to make ends meet, to just navigate this economy. People are suffering with lack of jobs and everything costing so much. It's very, very challenging. And so the CPI is coming out saying, our inflation rate is at 2.4%. No, it's not. No, it's not. It's not. But be that as it may, that is the data. And that data does move the markets. So the market today didn't quite believe it. So we traded yesterday. We took some great trades. We dips in the market. The market dropped down pretty significantly yesterday. And I had a feeling we might get another drop today. Well, we did get a little drop, but it has since recovered. Something that we are seeing is that the NASDAQ, that's the index that houses the tech stocks. So the main indices are going to be the S&P 500, that's the top 500 stocks, the NASDAQ, which are the tech stocks, the Dow Industrial, which tends to be a little bit more of the blue chip stocks, and the Russell 2000, which is 2000 small cap stocks. So these are the main indices that we watch. And the SPY and the NASDAQ have a relationship because the NASDAQ being the tech index also affects the S&P 500 because the S&P 500 is heavily weighted to the tech stocks. So we call those the Magnificent Seven. These are the top seven, or you could say eight stocks that actually run the market, if that's what you want to say. They really do, or they have. So this crazy bull run that we've been on for 2-3 years has all been run by these tech stocks and these Magnificent Seven: Apple, Amazon, Microsoft, Meta, Nvidia, Google, Tesla, and then of course Broadcom is a big one. These guys have been running the market for quite some time, and now over the last several to see cracks in the armor. We're see movement under the hood. We talked about this when I told you all that we are starting to see these magnificent stocks move into bear territory. So remember, we talked about from the all-time highs to a 10% drop, we call that a pullback. From the all-time highs, 10% and to 20%, we call that a correction. That's when the amber light starts flashing. From the all-time high, 20% and below, we call that bear market, bear territory. We are starting to see the Mag 7s, several of them entering into bear territory. Nobody's really talking about it, are they? Nobody's really saying, hey, what's wrong with Microsoft? What's wrong with Amazon? No, nobody's really saying that. But we are moving into bear territory. And it's only, in my opinion, only a matter of time before we start to see a strong pullback or correction in the market. I'm not calling for a bear market today, but I do think we'll get a bear market in 2026. What I do think is next on the rate pullback, at least a 10% pullback, is what I think is coming. Again, it doesn't have to be today, but I think it's coming. And this is something I've been saying since the end of the year. As we move into February, as we move into end of January, we're going to start to see the markets start to wobble. And that is exactly what's going on. Gavilan is here saying hi. If you're here and you haven't said hi yet, please drop your name in the chat. We are a friendly community of people here. We're a friendly community of traders. I welcome traders of all levels. I want to help you learn how to trade. So what we do here is I'm going to take some live trades with you if we get the right setups, and we're going to do some market analysis, and then I'm going to answer any questions or comments you might have. If you are new, there is no question that's dumb. There is no question that's too newbie. That's why we're here. And I'm telling you this, there are not too many people out there in the YouTube Finwit world who are doing what I'm doing, and that is trading live for free, giving education for free, and market analysis. There's not a lot of people who do that. Take advantage, guys. I've been doing this for a very long time. I do this for a living. I make my living by trading. I do well at it. So take advantage, guys, because I am here to help you. Drop your name in the chat. Say hi. Let's get to know each other. BD is here. Good morning, BD. All right. So let's analyze these charts. We are up right now about 22 points. So we had this pre-market little pump at the CPI as CPI came out, and I'll show you what that looked like. Okay, so coming into the morning, CPI came out pre-market. So let me zoom in. You can see that candle a little bit better here. And why is CPI so important? Because it is, like I said, it is one of the ways that the Federal Open Market Committee, the FOMC, or another, we call them the Feds, right? That is one of the ways they gauge what is inflation. So remember that the Feds have a dual mandate. They have two things that they have to, or supposed to, keep in check. One of them is maximum employment for the United States, and the other one is reasonable prices. Don't let inflation get out of control. Don't let unemployment get out of control. That is their mandate. They have one tool in their tool bag, guys, one, and that is the interest rates. They have quantitative easing as well, so I guess you could call it two tools, but they're those kind of work together. So their tool, they have their one hammer, and that is interest rates. However, these goals are often in tension because as we lower the rates, we can see inflation go up. Why? Because we're just throwing some free money out there. That's quantitative easing. We're throwing free money out there. What happens when you throw free market at the system, or free money at the system? What happens? Prices go up, right? If you are paying your employees $20 an hour to build a burger, guess what? As the consumer, you're going to have to pay $20 for a burger, just about. That is how it works. As they throw free money out there into the economy, prices go up. Well, that is a problem for those people that are not experiencing maximum employment or maximum wage growth. They're not. And so the other mandate is that they have to keep labor in check. They can't let unemployment run rampant. Well, guess what, guys? It's so bad. I don't want to be a doom and gloomer. I'm not a Debbie Downer, but when we just came out with the labor report, and so we got CPIs and we've got the Bureau of Labor Statistics, or as I like to call them, the Bureau of BS. The BLS is the Bureau of BS, in my opinion. Guess what happened in January? Very quietly, what did they do? They erased 862,000 jobs from 2025. That you will find it. Go look it up if you don't believe me. Go look up the revisions to last year's labor numbers. 862,000 jobs just never existed. They just never were. They never were there. And wow, that's a problem. Other reports that are not government reports are coming out and saying labor is the worst that we've seen in maybe decades. This is trouble. And so the market is going to respond. It is responding. These big AI stocks are getting repriced. The market is taking a more risk off sentiment, meaning, okay, I was willing to risk my money when everything was, running sky high. Now, not so much. Now I'm going to be a little safer. I might pull back out of this market. I might go into something that's safer. Well, what's safer? We call these defensive stocks or defensive sectors. The market starts moving into defensive. We see energy is defensive. We see healthcare is defensive. Why is it called defensive? Because there's certain things you just aren't going to be able to do without, right? You're not going to be able to do without medical assistance or healthcare. You're not going to be able to do without gas and electricity, right? You need that. So these are the sectors that are called defensive. We're starting to see rotation, big money moving out of these higher risk environments, moving into safer defensive areas. Okay. So, Gavilan asking, if the chart rolls to the downside, would that be a head and shoulders? What a great question, Gavilan. Let's take a look at that. I think you're exactly right. I do see a head and shoulders, and you are seeing it very well. Head and shoulders is a traditional bearish pattern, and I'll show you kind of what it looks like. Also, I am looking at puts here. I'm going to load up the 683s. They're a little bit elevated in price, so be careful. I'm not in them yet, but I'm kind of getting there. Hold on. We haven't quite come down to the VWAP yet. I'm just starting to roll over a little bit on the MACD. And we'll get back to that head and shoulders in just a minute. The pattern that's developing. BD, had a good week so far. I've had a good week, so no trades for me today. Hate taking risks in the chop going into a long weekend. I did take trades on my futures account. Low stress watching you trade. Thanks, BD. I appreciate being able to help you, and I am not disagreeing with you. When we are in chop, we need to be careful. I also have met my goal today, and so I'm going to be careful in taking trades. And we have been chopping. You're exactly right. We're chopping around here. So you guys know, I've said it many times, range bound market is the kryptonite to day traders, the kryptonite to scalpers. You guys have seen it on this stream. We get into a trade and sometimes we get stuck there as it just moves sideways. So that is what we want to avoid. I don't like, those are not wrong. We are range bound. All right, this put is on hold right now. We're not dropping. Let's get back to what is a head and shoulders. A head and shoulders is a pattern. It's a bearish pattern. I'm going to draw this out for you. Let me stretch it out and zoom in so it makes sense as we look at it. Let me get my drawing tool. All right, so a head and shoulders consists of a left shoulder, right here. The head is bigger than the left and the right shoulder. That's the head. This is the right shoulder. Okay. This is what we call the neckline. You draw an angled line, a trend line, basically. It's a trend line from the right shoulder to the bottom of the head. And this is called the neckline. Traditionally, we would say that the distance to the bottom of this pattern, it's a bearish pattern. If it plays out, it doesn't always play out, but if it plays out, we would see this right shoulder come down through the neckline And the idea is we would see the amount of move to the downside would be equivalent to this move from the top of the head to the neckline. Then you could double it to the downside, and that would be the expected move of a Head and Shoulders. They don't always play out. Right now, it could just be a rising trend line. But you are right, Gavilan, when you say this right shoulder is lower than the head. So that is what a Head and Shoulders pattern is. Remember that chart patterns are just that. They are patterns. We analyze them, we recognize them, we look at them, but they don't always play out. So you want, when you're looking at patterns, don't take a trade just solely based on a pattern. Use your indicators, right? And we've talked about indicators on this stream a lot. What are my favorite indicators? The VWAP, the MACD, the moving averages. Those are the main ones that I use. And if I had to live with only one indicator, it would be the MACD. If I could only have one indicator on my charts, it would be the MACD. I like the MACD a lot. And we'll go over those indicators if you like. We can go over what they are and what they do. So right here on this chart, this down here is going to be called the MACD. That stands for Moving Average Convergence Divergence. In a nutshell, it's two moving averages and the average of those moving averages. That is what the MACD is. The MACD measures the distance between moving averages. It is what's known as a momentum indicator. So it tries to tell us what is the momentum, what is the velocity of this move. And when you look at the MACD, let me zoom out so we can see a little bit more of it. When you look at the MACD, you can see that these green and red bars are telling you green, okay, we're moving up, red, okay, we're moving down. The longer the bars, the stronger the momentum. So let's look at this move right here. The MACD rolls over. You see it right here at 10:39 Eastern. MACD rolls over right on this candle, right? So what happens? Yes, it continues on down. The MACD is correct. It's saying we're going negative and it's correct. And as we move down, you see these candles moving down, you see the MACD giving you bigger red candles, bigger red bars. What's it saying? Yes, this move has legs. Yes, it has momentum. And then what happens? It starts getting a little, so we start seeing these bars get a little bit, let me zoom in. I want to make sure you guys can see it. I'll make this a little bit bigger. So we start seeing these bars get just a little bit shorter. What's that telling us? Maybe this move is over, right? And in fact, it is. So we get this move down, then we start to move back up again. Well, the MACD recognizes that. Right here, it says, we are starting to lose momentum. And so it's correct. And then it's a lagging indicator. So by the time it turns green again, we've already had 4 candles moving up. So it is a lagging indicator. Always bear that in mind. Most indicators are lagging. Okay. But then it rolls over here, it turns green, and it says, okay, we're moving up now. And what's happening? The bars, they're kind of wobbly a little bit, but then we get kind of a nice run here. And then what happens? We start getting darker green again right here at the top of the move. So this is my favorite indicator. It tells you not only the direction, but it tells you the momentum for the most part. Like I said, no indicator is perfect. Okay. The second indicator that I like to use is the VWAP. That is this white line right here. And that stands for volume weighted average price. So I have a lot of moving averages here. These are all just lines that are plotting a moving average of the price. But the VWAP, the volume weighted average price, takes the volume. So that's these blue bars down here. And you can see, right, we have certain candles that we get a bigger volume. That basically just means more people are trading it. right? We get a bigger volume push. There's more people in that trade. All right, guys, I am kind of thinking about puts here. Hold on. Not in them yet. I'm still watching. I'm considering whether this move is already passed us by. We have been in chop, so I don't want to jump in the middle of a choppy session. Yeah, not yet. Not yet. Okay. I'm going to keep watching this because I'm still thinking about it. But basically, back to the VWAP. So whenever we get a volume that is kind of moving up or beyond average, the VWAP gets adjusted by that volume. So it isn't just an average of the price, it's an average of the price that calculates additional volume. So volume weighted average price is the name of the VWAP. And that's a great tool. What I use the VWAP for is kind of like, I call it like a divider on the highway, right? We are either going north or we're going south on this highway. And the VWAP is the divider. It tells us, are we going north or south? Price action above the VWAP is bullish for the most part. Price action below the VWAP is bearish. This is one of the best things a newer trader can pay attention to. Watch the VWAP. Now, right here, we are over the VWAP. Would we take a bullish trade? No, because why? Well, we're getting a little downward trend here, right? But I'm not taking the bearish trade yet either. Now, I do take, okay, there we go. I do take bearish trades over the VWAP, but I always tell newer traders, be really careful and use that VWAP as your guidepost, right? All right, coming back to the flat line, meaning this is the area that we closed the day yesterday. That's an important zone. We are still in an upward trending, a bigger picture upward trend. So this little guy here, this is a little micro downward trend, but the bigger picture is an upward trend. So we also have to be aware of that. All right. I am going to let this put pass me by. If it does happen to break the VWAP, I might consider it, but it's just a little bit extended for me. And because we've been in chop, I'm going to let this move pass me by. Not going to take it. And that's something to remember about trading, guys. We don't need to take every setup that we see. We need to be picky about our setups. There are what I call A1, perfect, beautiful setups. Those materialize for me a couple of times a day. If it's not an A1 setup, if it is not looking exactly the way it needs to look, I won't lie, sometimes I do take them, but really it's much better to wait for the A1 setup. Much, much better. So at this point, this is not an A1 setup. I'm going to let it pass, even if it continues to drop. Now, if it, like I said, if it dumps through the VWAP, I might consider a quick put, but as of right now, I'm going to let it pass. Nothing wrong with that. What do we like to say? Cash is a position too. It is. Cash is a position, guys. Capital is king. The number one job of any trader, professional or not, protect your capital. That is king. Capital is king. So you are better off sitting in cash than you are taking a trade that might not be an A1 setup. Okay. All right. So yeah, second indicator was the VWAP. First indicator was the MACD. Second indicator was the VWAP. Remember, that's our highway. North of the VWAP, we are bullish. South of the VWAP, we are bearish. And we take the trades in accordance with our other indicators. So we're north of the VWAP, but we are not north on the MACD. So we're going to have to wait for the right setup. Now, if this pushes up again, would we take a call? Let's take a look at this chart. Do we want to take a call here? We're starting to get that signal, right? The MACD is wanting to roll over. Why would I not take a call here? What do you guys think looking at this chart? Why, if I didn't take a call or I did take a call, why? For me, what I'm looking at right now, what I can see, the pattern forming right now is this. I'll show you. Losing volume, great point, Anna. That is a very great point. We are losing volume, especially on this last move. I'm going to show you kind of what I'm seeing here, and that is what we call a pennant forming. Pennant like, think of baseball pennants on kids' walls in the 70s or 80s, right? I see a pennant forming. Losing volume. Excellent. Gavilan, MACD hasn't crossed. Excellent. You guys are right on. Volume and MACD are not confirming it yet. Now, MACD is starting to here. So would we take this call? The volume is lower. Now, this last bar here came up a little bit. But we are making these lower highs. Now, this is the minute chart. So remember, this chart is not as reliable as a higher time frame. So it's messy and it's noisy and it changes. But we also see a top that's coming down and a bottom that's coming up. Okay, now if we break this top right here, that would be a little bit more bullish. But if we don't, if we continue into the nose of this pennant, we will either break to the top or we will break to the bottom. This is what's known as a consolidation or a continuation pattern, meaning that price is consolidating. As price compresses, you can think of it as like winding up a spring. This price is compressing. So we have this big swing, almost as big of a swing, a little bit smaller swing, a little bit smaller swing, a little bit smaller swing. These swings are getting smaller and smaller, kind of like compressing a little spring. Eventually, it's going to compress enough energy that it's going to pop out the top or it's going to pop out the bottom. We don't know which one yet. So that's another reason why I wouldn't take the call. Even though the MACD did roll up, we see it there, right there. You're exactly right there, Gavilan. The MACD is one indicator that we're looking at. So, oops, I forgot I was in that drawing tool. All right. Okay, so as it compresses, we either pop through the top or we pop through the bottom. So even though the MACD was rolling up, even though we were over the VWAP, even though we could have maybe taken that trade, I would be careful because this top hasn't been breached yet. And you know what? A lot of times, guys, when I wait for these tops and bottoms, when I wait for lines to cross, a lot of times I miss moves. That's okay. It's really okay. I still wind up trading probably 15 times a day. So um, it's okay. For me, I'm okay waiting for a move to prove itself, right? And that's what this move needs to do. It needs to prove itself. We're getting this little teeny top here. Now, could it just bust out with a big volume bar and go poof, make a new high? Yes. Am I going to be sad that I missed the move? Not really. I'm okay with that. Um, see how it's just kind of hovering here? Look at that. Where did it hold, guys? Look at that. When you start seeing the patterns, you can't unsee them, right? So again, doesn't mean we won't pop up through the top. It just means I'm going to wait. I'm going to wait on this one. Okay. The other thing the other last indicator I'll talk about today is the hull, 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 like the hull of a ship, moving average, the hull moving average. I have a lot of moving averages on my charts. You guys can see them here. All these different colors of the rainbow. Those are moving averages, but the hull is my favorite. The hull changes colors when it senses a change in direction. So it's similar to the MACD. It tries to tell us, yes, we're moving up, yes, we're moving down, and it gives us a change in colors as it senses direction change. Now, like any other indicator, it is fallible. It makes mistakes. We get tiny little blips. And we get false signals like any other indicator. But when you use all your indicators together, you have a little bit of a better shot at it, right? So we've got our MACD, got our volume weighted average price, got our whole moving average. And when they all start telling you the same story, you have a better shot. For example, right here, when this MACD changed, right at, let me zoom in, right at 11:28 Eastern, right there. And the whole moving average changed a little bit earlier. So the whole moving average changed at 11:27, MACD changed at 11:28, and we're over the VWAP. All three of those things together would say we might consider a call here. And so we usually stand a little bit better shot when we're combining our indicators. Now, again, the reason you guys saw the reason I didn't take the trade was because of this pennant or this top that was coming down. So we still haven't beaten this swing high. This is what we call a swing high. So it came low and it swung up and it gave us a high. We still haven't beaten that. So that's kind of my level that I'm watching. Yes, we're breaking up through the top of the pennant. So that's good. That's bullish. And now I'm just going to watch this top here. Chances, I think, are decent that we will come back down, but we'll see because we've been rangy. So we'll see. All right. The other thing that I consider every day in almost every trade is the VIX. What are we doing in the VIX? Remember, the VIX is called the volatility index. And it is called that because the VIX tries to gauge the sentiment of the market. VIX is also nicknamed the fear gauge, right? If the VIX is going up, think of it as like a needle, right, on your tachometer. Are any of you old enough to remember tachometers? Remember the needle would come up, you know, especially if you're driving a manual car, and it would rev. That's kind of how the VIX is, right? It starts revving. The needle starts pushing up. It starts revving that engine because fear is building in the market. So as the VIX rises, as that needle rises, fear is building in the market. As fear builds in the market, it comes down. People start pulling their money away from their more riskier trades, right? And we talked about that earlier. We talked about basically the risk on and the risk off, right? So as the market gets fearful, it's going to pull out of these big tech stocks because those are more risk on assets. And it's going to start moving into the defensive stocks. And we talked about that, right? The energies and the healthcare, those sorts of things. So as the VIX rises, as that tachometer, that engine is revving, the fear is rising, the market begins to shrink, market begins to come out. And it's, where is that money going? It goes a lot of different places. It goes to those defensive sectors we talked about. Sometimes it goes to cash. So when the market starts to sink, if you watch the dollar index, you can see the dollar index come up because people move into cash or people move into bonds. That's this, the safest investment, right? Or so we're told, right? The US Treasury bonds are the safest. And so when we start seeing fear coming up, we start seeing the market pulling money away from the riskier assets, these AI stocks, these quantum computing stocks. These are higher, even you can see even crypto is shrinking right now because those are all classified as riskier investments. So when market participants start getting like, I don't know about this, they'll start pulling their money out into safer investments. And that is what the VIX tells us. The VIX starts revving up and we start seeing the market drop. And what did we see yesterday? Wow, what a drop, right? I want to talk about a big warning sign, and that's going to be the NASDAQ has now lost its 100-day moving average pretty convincingly. It has pretty much lost the 100-day moving average. That is institutional. The institutions are really focused on these moving averages, the 100, the 200, even the 50. But the 100 is the big one. When we start losing the 100, institutions start paying attention and they start setting their algos to sell, right? Now, sometimes we can come back and reclaim the moving average. Sometimes we dip below it and we reclaim it. We come back up. So I'm not saying all hell is breaking loose today, but I am saying if the NASDAQ cannot reclaim its 100-day moving average, the SPY is going to follow. We will sink as well. And that's not a bad thing, guys. So when we talked about, right, the pullback, that's healthy. We usually see in the market on average 2 to 3 10% pullbacks per year. Nothing wrong with that. Very healthy. The market moves in cycles, up and down cycles. Very, very healthy to get these pullbacks, to get these little resets, and to, continue on with our business. So nothing wrong with that. So a pullback is due and we're ready for one. So if the NASDAQ cannot reclaim its 100-day moving average, the SPY will follow. And we talked about the reason why. The SPY is very heavily weighted with the tech industry, which is how the NASDAQ is built. The NASDAQ is built over tech stocks. The S&P 500 has very, very heavy weighting. 35 to 40% of all of the S&P 500 is invested into mega tech stocks. So if the NASDAQ drops, we are following. And so we'll take a look at that chart in just a minute. But that 100-day moving average is huge, very, very important. And big money pays attention to those levels. All right. Yeah, Gavilan, 670 is a level I have. Gavilan saying I mentioned that if that happens, that SPY might drop to 670. And that's exactly right. 670 is a level. I have it marked here on my chart. I'll zoom out for you right there. Do you guys see that red line? 670. That is a level that got hit a week ago, Thursday, a week ago yesterday. That level got hit pre-market. It has not been revisited and it will be. It has to be retested. We don't know how long it's going to take, but it will be retested, that 670 level. So if we do start to get a bigger drop in the market, yeah, Gavilan, 670 is a target. Now, does it have to happen in one day? No, because we're sitting at 684. That's, if you convert SPY in your head to the SPX, that is 140 points on the SPX. So yeah, that's a big drop. Would that happen in a day? Could, but it doesn't have to. So yeah, 670 is a target. I do think we're going there, but it doesn't have to be today. We could try really hard to recapture some of these. The bear or bulls really want to recapture some of these levels. So I'll show you the NASDAQ. And right now I'm just watching this. I'm not trading calls here. We're at the top. I'm just going to watch for a pullback is what I'm looking for here. For my next trade, I'm looking for a pullback. In the meantime, rest assured, I'm watching this chart. We can talk about the NASDAQ and the 100-day moving average. It's crucial. It's a very, very important level. So here's our NASDAQ. NDX is the ticker for the NASDAQ. That is the NASDAQ index. Let's go to the daily. All right, take a look at this chart. This, do you see it? Do you see what I see? It's moving over and dumping, moving over and dumping, moving over and dumping. And what's happening, this low is getting lower, right? So it almost touched the low that we made on the 5th, almost touched it, got real close, and bounced back. But what's really important here is this 100-day moving average. Let's zoom in so you can see it better. This green line is the 100-day moving average. So every one of these candles represents 1 day. This moving average represents 100 of these candles. So this line is a representation of the price of the last 100 candles on this daily chart. So that line is very slow moving because it's looking at 100 days of data. So it's moving slowly and it's moving up. What is going on here? We came down, we pierced it right here on the 3rd, February 3rd, we pierced it. Well, before that, we actually touched it and bounced. This we see a lot, right? You want to see the bulls come in there and say, nope, we're not going to break the 100. And sure enough, that's what they did. But on the 3rd, we pierced it, pulled back up. But what happened here on the 4th? Boom, we dumped. And then on the 5th, oof, we dumped some more. That's a pretty big gap away from the 100. And then we came back in on the 6th and again on the 9th and got some nice big green candles and tried to recover that 100. So see there, we closed over the 100 and everybody's happy. Okay, yay, happy days. And then what happened on the 10th? Boom, we lost the 100 again. On the 11th, boom, we lost the 100 again. What did they try to do on the 10th and the 11th? They tried to pull it up. You can see it. They tried. They got up here. They got up here. But nope, couldn't do it. Nope, couldn't do it. And then what happened yesterday? Boom, big drop, big heavy selling pressure. That is the amber light flashing right now. Okay, so today, bulls are really trying, aren't they? They're like, okay, green candle, let's do this. They're trying to do this, right? But they've got a lot farther to climb. What's the other thing happening on this chart that needs to be looked at? It's called the death cross. If you have ever seen or heard of, there's 2 types of crosses, the golden cross and the death cross. These are when moving averages, a fast moving average crosses above or below a slower moving average. What do we have happening here? This golden line is the 21-day moving average. It's a faster average. This royal blue line is the 50-day moving average. And of course, the green, is the 100. As the faster averages start sinking, right? This slow average hasn't caught up yet. The 100 hasn't caught up yet. It's looking at 100 candles. It still thinks we're okay. The 21 says, we're not okay. The 21 says we are coming down. As the 21 crosses, here it crosses the 50, and then here it's just about to cross the 100. That is what's known as the death cross. When the 50 finishes its descent and comes down through the 100, that will also be known as a death cross. It is a faster average crossing a slower average. So this is also a warning sign right here where we see these moving averages fixing to cross, okay? So doesn't mean we can't go green today, doesn't mean we can't move up, but we are getting into dangerous territory. And we have the mags, all of the Magnificent Seven, a lot of them already in bear territory. Amazon is in bear territory. Microsoft is in bear territory, meaning they are down over 20% from their all-time high. That's a warning signal, okay? All right, so we are still climbing over here. Let's go back and look at our minute chart. Climb, climb, climb. We are up. Let's go to the ES. 32 points from yesterday's close. We've climbed up 32 points from yesterday's close. So the bulls are giving it their best try. And yeah, could we climb up today? Yes, we absolutely could. We've had 4 red candles, so it's time for a green candle. However, this could be nothing more than a dead cat bounce. And we've talked about those dead cat bounce. It's a terrible word, a terrible name, but it basically just means a bounce that doesn't go anywhere. It tries and then it falls back down. That's a dead cat bounce. Is that what happens today? Is this nothing more than a dead cat bounce? We will see. We'll watch and see. We are also going into a long weekend. So Monday, what is it? President's Day, guys, I think. Monday markets will be closed. So I won't be live here on Monday. I'll miss you all. But we will be back on Tuesday at 11 a.m. Eastern. And we'll take the day off on Monday. And I hope you all enjoy your weekend and have a nice Valentine's Day. But yeah, we will come back on Tuesday. So with this being a Friday, with us having had already 3 red candles on the daily, could we get a green candle today? We sure could. Could we get a dead cat bounce? We sure could. And given the fact that we've got a long weekend coming up, it's possible, right? I still am feeling more bearish than bullish, even though we've got a nice climb going on today. Over the weekend, over next week, I think we should be seeing some more negative behavior in the market. And another part of that reason is the VIX is still elevated. We're sitting at 19.7. Whoa, how are we up 30 points, guys? And the VIX is sitting at 19.7. That doesn't add up. When we see the market happy and complacent, we want to see the VIX below 15. When we start getting elevated up over the 17s and 18s and into the 19s, the market is still jittery. We might be doing this climb here, but the VIX is saying, I'm calling BS on this climb. That's what the VIX is telling us. Doesn't mean we won't climb today, but the VIX is saying, not everybody is feeling complacent today. So be aware of that, right? When we have an elevated VIX, we can experience quick, sudden drops. Not saying that has to happen today. We could go green, but over the next weekend and the next couple of days, if the VIX remains elevated like this, we could definitely see some more movement down going into next week. Okay. All right. So I am waiting on a reversal here, and it's just hasn't happened yet, but I was looking at 683 puts. We've moved away from that. The money is now sitting at 685. So I'm going to look at 685 puts, but I'm not in anything yet. because again, we are climbing. I'm just looking. I'm just watching for a reversal. So are we overbought? Not quite. The RSI is not quite overbought yet, but we are getting close to the top of the outer edge of the VWAP. Let's see if we get a little toppy here. We slow down. All right, Gavilan did well today. Left a runner at 677, hoping for a downward turn. Good luck, Gavilan. I'm guessing you mean a put runner at 677. So good luck to you on that one. The other thing that's happening today is Bitcoin is giving us a nice move up after really scraping its knees, man. Bitcoin has been knocked down. And so we are getting a little bit of a bid, what we call a bid, people buying. And the Bitcoin has moved up into 69 again. I think were we down below 65? It was bad. It was so bad. But Bitcoin catching what we call catching a bid today, moving up almost 6%. And of course, taking BMNR and MSTR with it. BMNR is the Bitmine Ethereum treasury, and MSTR is the Bitcoin. It's Strategy is the name of the company. It's the Bitcoin treasury. BMNR is Bitmine. That is the Ethereum treasury. It's all crypto. And as Bitcoin moves, these treasury companies move with it. So MSTR up 8% today. BMNR up 9% today. Beautiful move up on both of those. All right, getting a little bit of weakness here, right here. See if we want to get this thing to roll over. Not yet. The MACD is saying we're starting to roll, but the whole moving average doesn't agree yet. So we're still kind of this turquoise blue color. And that's the whole telling us, no, we're not rolling over yet. The MACD is saying, yes, we are. So I like to see them both in agreement. And we are pretty elevated over the VWAP, so we got to be careful with counter trend trades. That would definitely be a counter trend trade if we took a put right here, because we're seeing overall a climb in the market. So if we zoom out, you can see this upward trend. See, zoom all the way out and you'll see the patterns. Upward trend right here. However, again, we are getting this narrow nose, right? This narrow nose of the triangle. It's starting to slow down a little bit here. So let's keep an eye. It is very bullish right now on this move up, but let's keep an eye and see what goes on. Do we get another leg up, or do we start tiring out here? Let's see what happens. The VIX is coming down a bit, down to 19.5, which again is that's not low for a market that's up 30 points. All right, starting to get some signals here. Like I said, MACD rolling over just a little bit, but the whole doesn't agree yet. And again, they could close today's candle green. And I would say it's even likely that they would close it green after 3 or 4 red days. So we definitely could see them just bring it up to a certain level, park it there and close it. That is very possible, just to get that green candle today. All right, starting to beat this top just a little bit. And there it goes. Let's zoom in a little bit. Pretty firm top. It's just pushing through right now. All right, still pushing. 37 points up. So we could have taken that call trade back there, back here. We could have taken that call trade and made money on it, but I don't regret not taking it, because we were needing to beat this top here. So I'm willing to let this finish its climb wherever it decides to stop. And again, they could just push it up and run it sideways. So we got to watch for that. It doesn't have to drop down today. Let's see what the Qs are looking like. Qs are sitting at 0.68% increase. So we're right neck and neck with them. The SPY sitting at 0.60. Gold and silver back up today after a drop yesterday. IWM is kind of leading the charge here, pushing upward almost 2% on IWM. Wowza. That's a big move for the IWM. Remember, that is the ETF over the Russell index. Gavilan, thinking I made a mistake with the runner. It's okay, Gavilan. The thing is with the runner, as long as you kept it small and less than you're below the amount that you profited today, yeah, it might take a hit, but you'll still finish green. That's kind of my rule on runners is low risk, make it a small trade. And, if the cost of that trade is less than your profit for today, you're still okay. So no worries. It's okay to have those losing trades. Not a problem. Not a problem at all. All right. So again, Russell really leading up heading up the whole team here with that almost 2% run up. Let's see what the Dow is doing. Dow is up 0.4. Interesting that the mags are down. The Magnificent 7 ETF is down 0.24%. That's a little divergence, and so is the VIX elevated. A little bit of a divergence here, so something to be aware of. Yes, very small. You guided me very well. Oh, thanks, Gavilan. You're the best. I'm really glad. I'm glad that you did that and didn't hurt yourself. So congrats on that. Okay. Starting to get maybe a little weakness here. Google down 0.8, Apple down almost 1%, Nvidia down 1.6%. Do we have any of the Mag 7 up here? Tesla up 0.5. That's the biggest one. Amazon 0.3. No real strength here in the Mag 7. Do you guys see that? That's a little bit of a divergence. All right. I'm looking at the puts here. The whole moving average is starting to give us a little pink. And we are at the end of the stream, so I don't want to jump into a trade that I can't guide you through, but I'm real close to taking a put here. Watch the next candle or two and see if it starts, this whole moving average starts leaning down, or if it turns and continues back up. So keep an eye on that if you're trying to follow on this trade. Watch the VIX. If the VIX starts coming back down and the SPY starts moving back up, no trade. But if we sort of continue this downward move and the VIX continues its upward move, we could consider a put trade here. I wouldn't stay in it long. I would take quick wins today. So, all right, you guys. I hope that you had a good session with me today. We didn't take a trade, and that's okay. Cash is a position too. It's okay. Enjoy your Valentine's Day. Enjoy your weekend. Tell someone you love them. It's the best thing in the world, and life is too short, right? So enjoy your weekend. We'll be back again on Tuesday at 11 Eastern. And thank you so much for joining. If anybody wouldn't mind just giving me a like, I really appreciate that. I'm really trying to grow this channel. And so I appreciate when you guys drop those likes in there. Thank you so much. Have a great rest of your weekend. We'll be back on Tuesday. Bye for now.